We are live in 30 seconds. Hello, everybody. Mark Bilger with Bilger Insurance here. And today we are going to go over the basics of Social Security, when you can join it, what qualifies you to be eligible for it, how your benefits are determined. Should you take it early? Should you delay? Which is not really a decision I make, but I can show you how to make it for yourself. And then we'll talk about spousal benefits, how those can be determined, survivor benefits, if anybody's a widow or widower, what would happen. And then a little bit about Social Security taxes, if your Social Security is taxed, and a little bit about guaranteed income, which is what your Social Security is. It's a good part of your retirement. And then we're going to talk just a little bit about how Social Security touches with Medicare, because a lot of people think they're connected to each other, and to a certain degree they are, but not as much as a lot of people think. So we'll kind of clear that up a little bit. So we're going to go forward. We're going to go through it. I'm going to show some slides and kind of be back and forth. So we're going to just start with Social Security. And then just to let you know, I do not work for Social Security, nor do I want to work for Social Security. I'm not a representative of Social Security, so I do this on my own as educational. I am a registered Social Security analyst, so I have a different designation, but it is not through the government, and I'm not employed by the government. All right, so let's talk about just a little bit, because it's in the news all the time. Everybody thinks it's going to run out of money. All right, because since 2010, it pays out more than it takes in. Well, there's a trust fund that they created years ago. I'm not going to be real specific about dates of things, just giving you the overall concept. They kind of knew this would happen, so they created a trust fund because of all the baby boomers. Well, now all the baby boomers are in it, and they're taking it, and that trust fund is scheduled to run out at about 2033. And if they don't make some kind of fix, then benefits are going to be reduced, probably about to 81% of what they currently are. So when you hear people say, oh, Social Security will go away, it won't ever be there, trust me, we were saying it when I was a kid. It's still there, it's still running, it's not going away, nobody's going to get rid of it. It is going to change. How is it going to change? Well, we don't know. You know, the government, they could extend the full retirement age. There's a lot of discussion about that, making it 70. As most of you know, it used to be 65 and now it's 67, and they did that over a series of years. It would be something like that. They can increase taxes. They can always do that. More of that FICA money can go into our Social Securities. They could cut benefits, which is not something anybody wants to do, but it's always an option. Or they can just print more money and kick it down the road, which is not something that we haven't seen before. Which one they're going to do, we don't know. It's probably going to be a combination of all four to some degree. All right, let's start talking about individuals, and are you eligible? Well, you're eligible if you have earned 40 quarters of qualifying credits. What does that mean? It means you've basically worked for 10 years. You've had some kind of real job. Doesn't mean a career, just a job where you made kind of regular money for at least 10 years of your life. Now, some people didn't work that much, but they may be married to a person who did. Well, guess what? They qualify also. So if your spouse has 40 quarters, then you also qualify. You also have to be at least 62 years old. Sometimes people think they have to wait till 65 or 67 or whatever they think it is. You're actually eligible at 62. Now, that's where we get into the discussion about taking it early or delaying it, and we're going to cover that in a little more depth here in a minute. When can you enroll, or when do I enroll? Well, if you're going to start, whether you're 62, 65, or whenever it is, You want to start the process 2 to 3 months before you want your benefits to start. But keep in mind, whatever month your benefits start, you don't get a check till the following month. It's always a month behind. So say you want to start in May, that's when your start date is, but your first check doesn't arrive till June. So when the time comes, just kind of, put that together, because if you go a month without money that you're counting on, that's going to be an uncomfortable month. But your check is always a month behind the month that it's counted towards. And then how do I enroll? They make it pretty easy. Go on ssa.gov, not .com, but .gov. Create your Social Security account, and then you would be able to enroll yourself through the website. And it's as easy as that. All right. So what do we do? Why are we having this conversation? We want to help you optimize your retirement benefits. And there's a difference between maximizing it, and you see that a lot of times. What's that mean? It just means to make it as large or as important as possible, regardless of everything else. Well, a lot of times that's okay, but with your Social Security, remember I mentioned it's a big part of your retirement. We'd rather optimize it, and that means to make it the best possible while considering the other constraints and factors, because we want it to be the most effective and have the best results. So it's not always going to be the biggest. It's going to be the most optimal for you, your lifestyle, and all those kinds of things. So we're going to talk about that. So as we go through, I already know a bunch of the questions. Well, I shouldn't say a bunch of the questions, a couple of the questions that people want to know, because you're going to hear me say FRA all the time. What is FRA? That's your full retirement age. So based on the year you were born, this is the age at which a person becomes entitled to 100% of his or her full PIA. There's no discounts or credits. This is your number. So that's always followed with, well, what is my PIA? Well, your PIA is your primary insurance amount. That's the amount you're going to receive if you elect to begin receiving your benefits at your full retirement age. So you need to know what your full retirement age, so you'll know exactly what your primary insurance amount is. And if you want to learn what that is, we check out this chart. Most people that are coming to these seminars or coming to these webinars are at 67 now. They're born after 1960. If you're born a little bit before, you can see that's where they went through the progression of raising the age from 66 to 67. And if you're in 69 or 59, it's 66 in 10 months, and so forth. If you were born after 1960, your full retirement age is now 67. Those are the dates we're going to use. Then they want to know, how is my PIA determined? And I'm not going to go through this slide completely because the numbers don't really matter that much. The numbers are going to be determined off your age, when you were born, when you turned 62, the money you earned, things like that. The ones that do matter are up here in the top left. How is your Social Security determined? It's based off your highest 35 years of working. So all the years that you paid into Social Security, they're going to use the highest 35. So if you have 10 years of zeros, all those zeros get averaged in to those 35 years. And then they'll take that number and divide it by 420, which is the number of months in 35 years. And they're going to come up with this number right here, your average index monthly earnings. And that is the average earnings over those 35 years, but it's indexed. So if you're like me and you were working in the 80s and 90s and you made $285 an hour at your first job or whatever it might have been, those years count, but they get indexed as if they were currently or closer to this year. Once you're 60, there's no more indexing. Everything is just dollar for dollar. So they figure out that number and, wow, that looks like a great number. People think that's going to be my Social Security. That is not your Social Security. That's the number they use to run through their bend point breakdown. These are the numbers that don't really matter to you. But based on these numbers, which are determined the year you turn 62, they're going to run it through these multipliers, and that's how you're going to get your number. So the first bend point, you get 90%. The second one, you get 32%. The third one is for high earners. If you're over a certain amount, you get 15%. This person in this example did not. So this is their primary insurance amount, $2,340. So this person who earned $2.2 million over 35 years is going to get $2,340 per month once they turn on their Social Security at their full retirement age. Just a little bit of information, in 2026, the average Social Security amount is $1,976. And the most anybody can get is $5,108. So you can see if that's the average, some people earned a lot and they're still going to get up to $5,108. Can't get any more than that. So even LeBron James can't get any more than that in his Social Security. So if you're at that amount, you and LeBron James have something in common. Turn that off. All right, so how are we going to optimize? This is the part that a person like me can help you with, but it's really going to take a little discussion or a little bit of thought on your part, on you personally. We want to look at it in a holistic way. And first, we will look at the things that we know or the things that we can determine easily. And that's going to be, what are my fixed expenses? What's my mortgage if I still have one? Or do I have any revolving credit, loans or insurance? And about what do I pay for food and utilities? Those things are usually pretty fixed or pretty close. And then I have some other variables, but I can usually know what those are too, or I can control them. Travel, shopping, vacations, different entertainment, things like that. And then I can also know what other retirement assets I have. Do I have a pension? Do I have 401k, IRA, any annuities? Do I have a life insurance or a reverse mortgage? Anything like that. Those things we can know and we can make a determination. The things we may not know are a little harder to determine. Things like your future healthcare needs. Will you be a caregiver for someone else? We never know those things. Will you need extended care? Other people's money situation. There's a lot of older adults that are still helping their kids or they're helping their grandkids. Is that going to be a situation for you? What's going to happen just in general with the government, the economy, inflation? Those things are kind of unknown. And then there's some other things that might be known, but they're often left unsaid. Like, do you even like working anymore? What's your current health like? Are you already sick? Do you have any health problems? How long do you expect to live? Does your family live a long time, or is it the opposite? Is working ruining your health? Do you really need a few more dollars, depending on what that amount is, every month, or could you be happy with a different amount? And do you hate driving to work, or all those kinds of things? These are the things that will help you determine whether you want to retire or start your Social Security. So as we go to figure it out, there's a little bit of other information. If you're a female age 60 and you're in good health now, there's a 50-50 chance you're going to live to be 93. That's a long time. And a male 65, 50-50 chance to live to be 90. So people are living longer, staying healthier longer, and quite honestly, living while they're sick longer, but they're still living longer. And here's the first question then most people want to know. Should I collect it early at 62, or should I delay till I'm 70? Because if I delay, I actually get more. So I want to go back just for 1 second and remind you, our full retirement age, right there in the middle, is when we turn 67 for most people born after 1960, going forward now. So we're just going to use this example. This person's going to get $2,500 a month if they retire, or if they take their benefits, I should say, at their full retirement age, 67. They can take it early. What happens if they take it early? they take a discount, and the discount is permanent. It does not go to the full retirement or to the primary insurance amount when they hit that age. So if they decide to take it at 62, they're going to take a 30% discount on it, and they're only going to get $1,750, and that's what their monthly payment is going to be going forward. Now, there are cost of living adjustments every year, but they're somewhat insignificant, I should say. They're never going to blow the doors off. They go up a little bit, so that number will go up, but they'll never catch up to that 2,500 just because you're getting older. Every year you delay, then it goes up a little bit more until you're at your full retirement age. And Social Security actually lets you delay past that age, and it has a guaranteed 8% increase each year that you wait, up to 3 years. You can't delay it any more than the 3 years. So at 70, you couldn't delay it and get up to another 32%. 70 is the max, and it's going to be a 24% increase. Now, what a lot of people don't realize is they actually figure that out monthly. So if you wait a year and 4 months, it'll be somewhere between, it'll be over 8%, but not 16%. So it's actually done by month. So there is a prorating that goes on. All right. So people decide, well, can I still work? Maybe I want to take it early, get some income, but keep my job or keep a job. And the answer is yes, absolutely. You can continue to work, but you're subject to the Social Security earnings limit test. And this keeps people from taking it early, double dipping, having a really good job, making a lot of money. So what do? They look to see if you are under your full retirement age. So if you took it at 62, 63, 64, something like that, and they put a limit on it. The limit for 2026 is $24,480 a year. Well, that sounds good to some people, but you got to remember there are no dummies there at Social Security, and you're not going to claim it and just work for the year, January 1st to December 31st. It's going to be somewhere in the middle. So they actually do it by the month. So the limit is actually $2,000, $2,040 a month. For every $2 over the limit, they're going to withhold $1 of your benefits. So if you exceed more than $2,040 in a month, they're going to, for every $2 you go over, they're going to keep one of those Social Security dollars. Once you reach your full retirement age, so if we're using 67 right now, that year they'll let you go up to 65,160, which again is 5,430 per month, and they're actually going to go by the month. And they give you a little more grace. For every $3 over that limit, they're going to take $1. So you get a little bump there, which is actually pretty significant. Then once you hit your full retirement age, no limit. You can work and make as much money as you want and receive your full benefit. There's no penalty for that. There's no withholding. If you hear a lot of talk about overpayments, one of the main ways people get overpaid is they exceed these limits when they're working. They don't report it. The government doesn't find out about it for months or years later. They're going to go back and claw that money back then. And that's the overpayment. And from their point of view, that's your fault and you owe that money back. So that's a very uncomfortable situation to be in. So make sure whatever year you decide to start your benefits, if it's under your full retirement age, you know what your earnings limit is and you know how it's measured by month so that you don't get yourself into an unfortunate situation. So what do they look at to determine your income? Wages from self-employment and earned income. So your hourly work, your salary, if you pay yourself being self-employed. They don't look at your 401k withdrawals, 403bs, pensions, IRAs, any of that. That does not get counted into your income for earnings limit. They do get counted for other things, but not your earnings limit. So that's the answer to, can I keep working? You can. Be sure you know how much you can earn. And then once you hit your full retirement age, then you can do whatever you want. Spousal benefits. This is often very confusing for people. There used to be some other rules that people thought they could take advantage of. I can just tell you, without getting too deep into the weeds, those rules are gone. So it's not very confusing, and there's not that much to figure out for spousal benefits other than knowing how it works. So how does it work? Well, a spouse is eligible for up to 50% of the higher earning spouse's benefit. And how do they make that happen? They take the lower earner's benefit and they just bump it up to equal 50% of the higher earner. So let's take a look at an example of that. So we have two people, they're married, Jeremy and Samantha. Jeremy's PIA, his primary insurance amount that he's going to get when he turns 67, is $2,500. Samantha never worked. They were high school sweethearts, got married, had kids. She stayed home, never worked. So her spousal benefit is up to half of Jeremy's. His is $2,500, so her spousal benefit is $1,250. So she gets a check for $1,250. He gets his check for $2,500. They have a total cash flow or household income from Social Security of $3,750. Because she can get up to half of his amount. So what if Samantha did work for a while? They had some kids, they got a little older, she did go back to work. Well, Jeremy's is still the same, $2,500. Her benefit is going to be $1,000. Well, she can only reach half of his, so her spousal benefit is now $250 because she can only have $1,250, which is one half of $2,500. Their household income is exactly the same, $3,750 from Social Security. Their total cash from Social Security. One more example, Samantha worked pretty much full time. She has a pretty good benefit of her own, $1,250. That's already half of Jeremy's. She doesn't get a spousal benefit because she's already reached 50% of Jeremy's. Their household cash flow is still $3,750. So it doesn't change how much the household gets. It just bumps up the lower earner to half of the higher earner. And that's how spousal benefits work. Of course, they're going to let you decide when to take your spousal benefit. So Jeremy has to be taking his, of course, but then Samantha can pick hers. So at her full retirement age, her benefit's going to be, $500. But if she wants to take it early, her spousal benefit gets reduced also. So just like her personal benefit, if she takes her spousal benefit, it's going to get reduced. On the other hand, she cannot delay her spousal benefit and get any delayed credits. And so there's no reason to do it. Once she hits her full retirement age, if Jeremy's receiving his benefits, she should turn on her spousal benefits because it's not going to get any higher. But what happens if she's going to take it early and she's going to take hers early? So her own benefit, remember, it's $500. She takes it early, she takes that hit, right? So now she's down to $350, or she could delay hers, take it at $70, and now she gets $620. So that's good. That's her option. She can do whatever she wants with her own retirement benefit. She wants to add her spousal benefit. Well, she can get up to $1,250 because that's half of Jeremy's. Hers at 65 or 67 would be $750. $750 plus $500, it's $1,250. But remember, you take anything early and you get a discount. So now she gets a discount on hers and a bigger discount on her spousal benefit. Her total is only going to be $837 because she took it early. But she can't delay. So even though she can get a bigger amount on hers for delay until 70, she can't make her spousal benefit any bigger. So it's still going to be at $1,250 at 70 years old. So she can't make that one go any higher, but it can go lower if she takes it early. This kind of math gets really confusing. We have software that does this for us, and we'll talk about that in a little bit. If you'd like us to go through that for you, that's something we can do. I can tell you the worst place to find out this information is calling the Social Security office. they're not going to understand this, and they're not going to have the time to sit and do different ages with you. We can do something like that for you. What if I have an ex-spouse and I'm not married to him anymore? Well, that's okay. You got to be at least 62 and you had to have been married for at least 10 years. So real short-term marriages aren't going to do anything for you. You must not be remarried if you're going to claim on your ex-spouse, and you must be divorced for at least 2 years unless your ex-spouse is already claiming their benefit. Then you don't have to wait. Still have to have been married for 10 years, but you don't have to wait if they're already claiming theirs. They must be at least 62 years old or on Social Security disability. All right, so they have to at least be eligible to get theirs. If they remarry, it does not affect you, it does not affect them, and it does not affect their new spouse. And the good news is you don't have to talk to them. You can simply call Social Security and give them the information, and they will confirm your eligibility. So again, it doesn't affect their new spouse, it doesn't affect them, and it doesn't affect you if they remarry. Survivor benefits. This is where spousal and survivor get confused sometimes. So we'll go through this and we'll try to clarify that for you. So in summary, once survivor benefits come in, only one check is paid to the survivor, which means there's going to be a big gap in the retirement income. They're going to get the higher of the two checks. So if the lower earner passes away, they're going to lose the lower earner's check and keep their check. The survivor will. The overall income goes down. So there's always a pay cut for the survivor. You can file for survivor benefits on a deceased ex-spouse as long as you're not remarried before the age of 60. Any delayed earning credits that are already earned do apply to survivor benefits. So this is one of those differences where people might get confused. Spousal benefits, there's no delayed increase. Survivor benefits, there can be. You can switch between your benefit if you're the survivor and the survivor benefit. You can turn one on, let the other one grow, and then turn that on. There's different combinations of why and when you would do that. That's the kind of stuff we can help you figure out. Spousal benefits, you cannot. There used to be a rule, that's what I was mentioning earlier, where people could turn one on and turn one off and move this and suspend that. That's all gone. So don't worry about it. It's not as confusing because they did away with those options. But you can switch between your personal benefit and your survivor benefit. You can continue to work, but it's going to have the earnings limits just like before. And if the deceased person took theirs early, if they took them at 62, for example, then the survivor will get a maximum of 82.5% of the PIA for the person who passed away. So taking things early always reduces the amount you're going to get. And you must have been married for at least 9 months. There's a few exceptions, but there's so few that it's not worth discussing. So what are the main points? The surviving spouse always takes a pay cut. They always take a pay cut because they're going from 2 checks to 1 check, even if it's the higher check. They may feel like, oh, I was getting 1,000, now I'm going to get 2,000. Well, the household was getting 3,000. Now you're getting 2,000. And that's a big deal. So those 2 checks just become 1 check. And so in general, the higher earner should delay taking their Social Security as long as possible. Now, notice I underlined and made in general bold. Generally, that's the financial or the mathematical way to increase the survivor benefit for the person who survives. If people pass away in an unexpected order, it doesn't really matter at that point. If you know, there's no definite yes or no, but in general, that's the way we look at it. All right, our favorite discussion, our Favorite thing to discuss, taxes. Do we pay taxes on Social Security? Absolutely, we do. At least a lot of people do. So what counts? Remember, for earned earnings limit, wages, and earned income is all that counts. To determine whether you pay taxes on part of your Social Security, what counts is almost everything. They don't let you get away with much. So your adjusted gross income, which they also include non-taxable interest, which is municipal bonds. If you have any of those, that's going to get added in. They're going to add in 50% of your Social Security benefit, your wages, your salary, self-employment, your distributions now from your pensions and IRAs. Those do get counted because those are regular income, interest and dividends, capital gains, any rental income or royalties, any unemployment benefits. All that gets counted in. What doesn't count, kind of the things we already know about, Roth and Roth 401ks. Life insurance payments are non-taxable. There's a lot of programs now where if you have long-term care, the money you use for actual long-term care, if you take it out and use it for long-term care, can be tax-free. Some qualified annuity income is tax-free. Gifts and inheritance are tax-free to you, not to the person who gives them. Loans, if you cash out, refinance a home, get a reverse mortgage, take life insurance loans, none of that is counted as income, and veterans benefits. Those don't get counted. So you take all the things that do count and you add them up. And if they fall between these thresholds, it tells you whether you do or don't pay taxes on part of your Social Security. So if you're married and filing jointly and all those things added up are less than $32,000, then you don't pay any Social Security tax. If, on the other hand, you're between 32, so 3201 and 44,000, up to 50% of your Social Security is taxed. And then if you're married filing joint and your joint income is greater than 44,000, then up to 80% of your Social Security is taxed. Now, that doesn't mean your Social Security is taxed at 80%. It means up to 80% of it can be taxable, figured in. So a couple of things, up to 50, up to 85. How does that get decided? It depends on where you are in there. Again, it's something that's really better just to use the software to figure that out, and it tells you exactly how much of your Social Security is taxed to the dollar. We can do that. And then people think, well, how many people pay tax? Well, if you only have to be at $32,000 married filing joint, and if you're both getting $2,000 a month, that's $48,000 just in Social Security. So actually, you're already up here. Most people, well, I shouldn't say most people, at least 50% of people are going to pay tax on their Social Security. It used to be much slower. They didn't change the limits since they initiated this. And so a few people used to pay. Now a lot of people pay. This is something we can figure out for you. All right. So remember, we talked about your Social Security being a big part of your retirement. And the reason it is, and the reason it's so important, is because it's guaranteed money, right? It does go up a little bit with the cost of living adjustments, but it doesn't go down, and it's always going to be there. So that's really good. But what you need to do is make sure it fits within your other retirement plans or your other programs. And there's two things that are going to affect that: the sequence of returns on your savings and your investments, so any other things you have for retirement outside of Social Security, and your health care. That's the other thing that's going to affect it. And that's going to affect it in two ways. So to optimize your Social Security, we need to know how it's going to fit into the whole plan. So what's the sequence of returns? Well, that is what the market does if you have money invested. This looks really complicated, but I'm going to break it down and make it really easy to understand. Two people, they're both 41 years old. They both have $100,000, and they put it in to the market, and they just leave it. They don't take any money out. They just let it grow. Okay. And they both average 8%, right? The difference is for this person, he started off really terrible with down years, then had some up years, then a little mix. The other person had the same exact returns, but in the opposite order. So he started good, had a bad year, a couple of bad years or plain years, finished real bad. So see, he finished 12, 21, 14. He started 12, 21, 14. But they averaged 8%. They both ended up with $685,000, basically, a little less. Because they averaged the same. They weren't taking anything out. But what happens now? They want to retire. So now they're 66, the same exact returns, inverted, same amount of money, 684, 848, but now they're retired, so they're pulling 5% off. Well, the 5% plus the sequence of returns, this person runs out of money at 82 years old. They have zero money. This person, because of the sequence of returns, even taking out their 5%, they go up to 2.6 million. They never run out of money. In fact, they have way more money than they started with. Started with the same, had the same results, just in an inverse order, in a different sequence. Pulled out their 5%. This person ran out. That's why having guaranteed money is going to be so important, because if you are pulling from retirement and you get hit with a bad sequence of returns, it's going to run you out really fast. So Mr. A, zero money at 81. Mr. B, 2.6 million at 92 or 90 years old. That's a sequence of returns. That's something we can help you with. Why has that happened? Because if you're not too familiar with it, anytime you lose money in investments, you have to earn more than what you lost to get back to where you were. The simplest one is 10%. To get back up to where you were, you have to earn 11%. However, if you're taking 5%, you got to go up 44%. If anybody remembers some of the big drops, 2008, if you go down 30%, it has to go up 85% to get back to even. If you have a long time, like between 40 years old and 60 years old, that's okay. But if you're 70 years old, you don't have that kind of time. So we try to help people protect against those things. All right, Social Security and Medicare. How do they affect one another? Well, here's the first thing. Once your benefits are started, your Medicare premium is going to be automatically deducted from your Social Security amount. If you're taking Medicare, if you delay Medicare, that's not going to matter. That's where they kind of touch, but they don't. We help people with Medicare all the time. We can explain that to you on a different webinar or on the phone or whatever you want. But since they're going to take that, I'll use 2026 for an example. Medicare Part B base premium is $202.90, so $203. So if you call Social Security and they tell you your monthly benefit is going to be $1,000, it's not really going to be $1,000 if you're 65 and you're going to take Medicare. It's really going to be a little under $800 because they're going to deduct your Medicare Part B premium for it before you ever get that check. So Medicare is going to affect your Social Security check. But that's only part of your health insurance, because you're also going to have co-pays, you're going to have co-insurance, and you're going to have premiums for other types of insurance that you get to help boost the insurance you get through Medicare. Medicare doesn't cover your drug costs, so you're going to have to pay out of pocket for your drug costs or for a drug plan. And then if you have any non-medical recovery costs, traveling, say you want to go to a special hospital that is really good in cancer. I know here in Texas, MD Anderson in Houston. Well, if you don't live in Houston, you got to get to Houston. None of that is covered by Medicare. The lodging, time off work, if you need home aides to come in to help you recover for a while after a major surgery. If you want to try alternative treatments or experimental drugs, none of that is covered by Medicare. Plus, your income, including part of your Social Security, can affect the cost of your Medicare premium. And that's called an IRMAA. That's an income-related monthly adjustment amount. What does that mean? That means if you have a high income based off 2 years prior to when you start Medicare, instead of the base rate, which I mentioned up here is 202.90 this year, instead of the base rate, you get to pay an extra amount for your Medicare. So if you're a higher earner and you're married filing joint, if your joint income was $218,000 or less on the top row there, you get to pay the 202.90 and no extra IRMA on your drug plan, which is a separate charge. However, if you went over 218 by $1 up to 274, you get an increase to 284. Same Part B, but you just pay more. And they're going to add $14.50 to whatever your drug plan premium is. So if it was $20, you got to pay $34.50. And the thresholds go up. Now these are the ones we use in 2026. But what they're looking at is 2024. They're going back to your 2024 income. That's what these numbers are based off of. And this price is for both individuals. So if you're both on your Medicare, I'll make that a little bit bigger. If you're both on Medicare, you get to pay that twice. So for a couple, even at the base rate, you're at $205, $204 a month for Medicare Part B. If you're a very high earner, you're up there almost $700 per person per month, plus an extra 91 on your drug plan. So your income can affect how much you pay on your Medicare. Now remember, if you also start your Social Security benefits, they're going to take your Medicare out of your Social Security before you see it. So they're going to take this amount before your Social Security ever goes into your bank account. So there's a lot to be aware of, and it can feel overwhelming. So what are some of the key takeaways that we talked about today? When you start thinking about your Social Security, whether you want to take it early, delay it, when I should take it, when I want to retire from my job, or do I want to be partially retired and work part-time, all those kinds of thoughts, is we encourage you to focus on optimizing it versus maximizing it. And we can help you do that because the software we have can run it through and give you all the different options. And I can tell you to maximize it, to give you the highest number, I just put in that your life expectancy is going to be 105. And that'll give you the biggest overall number of lifetime earnings. Well, that's ridiculous. So anybody that does that is not doing you any favors. Know the benefits you're eligible for. So your retirement benefits, spousal benefits, survivor benefits when those happen. If that happens and you haven't started yours yet, compare taking yours versus delaying the survivor, or taking the survivor and delaying yours, all those kinds of things. Know the effects of your decisions. Remember, you take one early and it's permanent. Can you undo it? Yes. In the first year, there are a lot of rules around it. Yes. And you may not like some of the rules, but we can explain them to you. But after that first year, you can't really undo it. So know the effects of what's going to happen. Understand how the sequence of returns is going to affect your income in your retirement. And then understand how your income is going to affect your Medicare charges, which is also going to affect your retirement and your Social Security income. Prepare for the unexpected. Everybody wants to live a long and healthy life, and the longer we live, the less healthy we live. It's just the way it's going. We can live longer, but it's not always healthy. All right, and then just to wrap up, I've mentioned our software a little bit. We have a special offer. It's called the RSSA Roadmap, Registered Social Security Analysis Roadmap. For $149, we'll run it. You'll get a custom report. Shows you all the different ages. Spouses, all their different ages between 62 and 70, both spouses, what month they should take it. If you have spousal amounts, the survivor strategies, whatever would be available to you, whether you're married, divorced, widowed, we put all that in there. How your decisions are going to affect your taxes and your Medicare, right? What's your income going to be? Are you even going to have taxes? What's my Medicare going to cost me? which strategy provides the most lifetime income. This is back to the optimize versus maximize. If I say you're going to live to 105, that's going to give you the most lifetime income. Doesn't matter. Delay till 70 and live forever. Okay? That's not realistic. We actually use your ideas about how you want to live, where you want to live, how long you think you really live, all those things, and we try to optimize it for you. It's one of the most valuable planning things you can do. It's very, very reasonable. If you would like access to this software, just please comment in the chat, RSSA Roadmap, and we will send you the link. It has video instructions on how to put in your earnings report, which is pretty interesting. I think I can go back and see what I earned when I was 16, 17, 18 years old and remember the good old days. And then you can see how they index that and make it a higher amount, what it would be worth today. That kind of thing is pretty interesting. But most of all, for $149, you can understand your Social Security. I'll talk to you on the phone. We'll answer your questions, give you the digital report, send you the PDF to print it. If you're close by in the area in Texas where we're at, we'll even print it for you and hand it to you and go through it with you. So RSSA Roadmap in the chat. Anything to respond to, Paris? Oh, so we have one. Oh, sorry. I was married to my ex-husband. It came up on my top screen. For 12 years, he passed away. May I collect his Social Security? Yes, you may, if you're not remarried. So that's one of those questions that if he was qualified and if he wants it, and if it was going to be more than yours, right? So there's always a couple extra things in there. We just got to look at it and make sure just because you can do something, does that mean you should do something? Maybe not. We check it. All right. Any other questions for us, Paris? Nope. Well, I appreciate everybody who has been on today. Please reach out to us at info@billgearinsurance.com. If you'd like any other information, if you'd like the numbers that I showed you, we have those on a sheet that we can email to you, and we will be happy to answer any questions. So with no more questions right now, we will log off, and I appreciate everyone joining us today. Thanks.